The topic I chose was cash versus accrual accounting, and I believe it is important to better understand three subjects of business. One being business health, how the business is trending on a year over year basis. Two is business projections, determining what kind of profit the business can have. And then last, liquidity, what cash do you have on hand? Now, to understand this on a deeper level from the cash and accrual accounting, there's several examples that we can look at. First, though, we have to understand the concept of how cash versus accrual accounting is done. And that's that it's rooted in the knowledge that expenses are recorded when they are incurred during the period and matched against the revenue for the period. That's done from the Indiana Wesleyan resource. So the main differences are expressed in the name. Cash basis accounting focuses on transactions when cash is received or paid out, and it is not allowed under the GAAP. So, in short, if cash is not tendered, then it is not recorded. However, on an accrual basis, the transaction is recorded when the transaction occurs, and that is required by GAAP. So, no matter what the transaction is, when it occurs, it is recorded. And a company can use financial periods like the matching principle. You can use that as a way to record expenses against their revenue, show it as a loss. And although a company may have a large profit in a later period, that's what they can do. And that's usually done whenever close to the end of a fiscal year, more than likely for tax purposes or to roll over some sort of credit into the following tax year. Now, there's also some additional concepts that are with cash versus accrual basis. And there's the time period concept where businesses can be sliced some time fragments into just smaller ones where financial statements are prepared specifically for those periods. Now, if you were an entry level professional working retail, this is where it can come in handy because Black Friday and Christmas are some of the busiest times of the year. So, with the time period concept, there's businesses like Old Navy and Macy's and other businesses that can record their most profitable month and leverage those against their other seasons. For a mid level professional, the concept would be the revenue recognition principle, which is where accountants make journal entries for revenue when it has been earned and not necessarily when the business receives the money. So, if you were a manager of a distribution company and you typically work with accounts payable and accounts receivable, this is where this time concept or this recognition concept would provide a good basis because you would have an understanding of what the money has been promised and what is still yet to be paid. And that kind of information can be sent up the corporate ladder for approval. That helps the executive level understand inherently what's going on in the business. And that takes us into the executive professional. Usually they would use a fiscal year concept. As they're looking at previous 10Ks and with the cash versus accrual based accounting, if there's a period in time in which numbers tend to be lower, an executive can analyze those previous 10Ks to see when sales have been historically low and then center the fiscal year around that time period. That way, it's either beginning to show a strong trend if they have their lower months at the beginning of the fiscal year, or a downtrend at the end of the year that they can use for tax purposes. That way, they can lower the company's tax liability and show better numbers ultimately for investors and shareholders. But in my opinion, the largest ethical issue that can come of any of these concepts would probably be the revenue recognition program, mainly due to tax evasion. Since the accountant is instructed to record a specific number at a specific time, whether they may or may not have the money as a business, there's a lot of leeway for error. And so, with the cash versus accrual basis, seeing that it must be adhered to and must be adhered to the GAAP, it'd be crucial to have some sort of secondary accounting firm comb through a company's numbers and make sure to find a consistent balance in order to prevent any felony level offenses. So, in a nutshell, bringing it all together, cash versus accrual basis is a way for a company just to tender whether a transaction occurred in cash, which is not under the GAAP, doesn't need to be recorded that way, or if it was tendered on an account, which would need to be under a GAAP, under accrual basis. By understanding these differences in business and how it can either harm or help your business will allow you to have more freedom, more liability, depending on which way your company would want to go. Most companies would like to take on more tax credits to lower their liability so they don't have to pay more as a company, so they can use that extra injection of cash flow to push into something else. whether that's research and development, whether that's employee pay, bonuses, whatever it may be. But most companies usually use a plethora of different tools to limit their company's liability. And with the right principles, whether that's using revenue recognition or the time concept or matching principle, the companies that utilize these in an effective manner will usually have a lower tax liability and give them more runway to grow in the next year.